Now let's working on question 34. Branson paid $465,000 cash for all of the outstanding common stock of Wolfpack Inc. on January 1st, 2017. So 465,000 cash are likely to be the consideration paid. On that date, the subsidiary had a book value of 340,000. So this is the book value acquired, including common stock of 200,000 and retained earnings of 140,000. Although various unrecorded royalty agreements were assessed at 100,000 fair value, which means that royalty agreement is one asset that have a fair value different from the book value. Any remaining excess fair value was considered goodwill. Okay, so which means that goodwill will equals to the total excess amount minus the undervalue amount of the royalty agreement. In negotiating the acquisition price, Branson also promised to pay Wolfpack former owner additional 50,000. So this additional 50,000 is like a contingent liability if Wolfpack income exceeded 120,000 total over the first 2 years after the acquisition. At the acquisition date, Branson estimated the probability adjusted present value of this contingent consideration as 35,000. So 35,000 is the contingent liability, present value of this contingent liability, and it will be included as part of the total consideration transferred. On December 31st, 2017, based on Wolfpack's earnings to date, Branson increased the value of the contingency to 40,000. During subsequent 2 years, Wolfpack reported the following amount for income and dividend. In keeping with the original acquisition agreement on December 31st of 2018, 2 years later, Branson paid additional 50,000 performance fee. So that's their agreement to Wolfpack previous owners. And okay, so before we move on to answer this question, we can always use step 1 to have the allocation schedule prepared. That will be also it will be very useful for us to answer those following questions. So first, what is total consideration paid? So total consideration paid here, including 400. Including the 465,000 cash and plus the 35,000 contingent payment. So in total, that is 500,000. And the book value acquired, or the book value of the subsidiary company, is 340,000. 340,000. The number is given directly, 340,000. And then the excess of consideration over book value equals to the difference between 500,000 and 340,000. It equals to 160,000. So next, let's allocate this excess amount to those accounts with different fair value than book value. So the first account we know that is the royalty agreement. And is not recorded, and it has a market value of 100,000. Its remaining life is 10 years, which means that the annual amortization will be 10,000. Assume we use straight line method for the amortization. Alright, so that's the only account have a different fair value than book value, and the remaining amount will be allocated to goodwill. That is 60,000. And we normally do not amortize goodwill. So the total excess annual amortization would be 10,000. Okay, so this is the step 1 allocation schedule. I'm going to use the following videos to show you the solution of the questions. Question A. What is Branson's entry to record the acquisition of the shares of its Wolfpack subsidiary? So the journal entry is to debit investment in Wolfpack. The amount is 500,000. Credit cash. The cash consideration 465,000. And the contingent liability or the contingent payment. The present value of the contingent liability is 35,000. Alright, so that's the entry to record the acquisition of the share of its subsidiary. Question B. What is Branson's entry at the end of 2017 and 2018 to adjust its contingent performance obligation for changes in fair value and the December 31st, 2018's payment of the contingent liability? Okay, so at the end of 2017, what we know is that on December 1st of 2017, based on Wolfpack's earnings to date, Branson increased the value of the contingent to 40,000. Okay, so if that's the case, we need to increase the contingent liability by 5,000 because right now the contingent liability has a balance of 35,000. We need to increase that to 40,000, and associated with this adjustment, we are going to recognize a loss. Okay, so journal here is going to be that it will happen at the end of 2017. Debit loss and credit contingent liability 5,000 because they adjust the contingent liability up by $5,000. And then at the end of 2018, what happened is that in keeping with the original acquisition agreement on December 31st, 2018, Branson paid the additional 50,000 performance fee to Wolfpack previous owners is because the total net income earned by subsidiary is 140,000. That made the requirement of this additional $50,000 performance, performance bonus. So the first journal entry is to also be right now the contingent liability is 40,000, and we need to add additional 10,000 to the balance of contingent liability to make it 50,000. So we, in other words, let's use a T account to show what we're talking about. So we have the contingent liability. So this is the T account for contingent liability. And then at the beginning of 2017, the present value of the contingent liability is 35,000. The amount here. And then at the end of 2017, they make the first adjustment to increase the contingent liability by 5,000. And then when it goes to the end of 2018, they realize that the subsidiary's performance meet the requirement. So in total, they paid the former owner of the subsidiary 50,000, which means that there's the additional 10,000 adjustment related to this contingent liability is necessary. Okay, so this is going to be the additional adjustment at the end of 2018. The journal entry is to debit loss, that's another loss, and the credit contingent liability by 10,000, so that the final balance of contingent liability will be 50,000, and then they are going to pay this 50,000 contingent liability to the former owner, and the journal entry is to debit contingent liability of 50,000 and credit cash 50,000. Alright, so that's the journal entries for question B. Question C. What is the consolidation worksheet entries as of December 31st, 2018, assuming that Branson has applied the equity method? So if Branson has applied the equity method, then the typical journal entry we need, consolidation entry we need to prepare are the entry S, entry A, entry I, entry D, and entry E. Okay, so let's prepare them one by one. The first is entry E. Oh, sorry. First one is entry S. So entry S is to eliminate the subsidiary company's equity account, stock equity account. It includes, okay, so we go back here, look at the questions. We know that the subsidiary company has common stock, 200,000, retained earnings, 140,000. But this 140,000 is a beginning balance at beginning balance of 2017. Now we are preparing the consolidated entries at the end of 2018. So we need to calculate what's going to be the beginning retained earnings in 2018. So we'll come back to this later. So first, in entry S, we need to debit common stock, $200,000, and then return earnings. So this return earnings will be the subsidiary company return earnings at the beginning of 2018. Wolfpack. The question is how much is it going to be? And we credit investment. In Wolfpack. Okay, as to the 2018's beginning return earnings balance of Wolfpack, so this returning 1,180. So it should equal to 2017's beginning balance of the return earnings. So the beginning balance of return earnings is 140,000, and then the annual balance should equal to the beginning balance plus net income and minus dividend. So this income and dividend are the subsidiary company's data. Okay, so come back here. The annual balance of return earnings should equal to 140,000, 2017's beginning balance of return earnings, and plus 2017's net income, and then minus 2017's dividends declared. Annual balance equal to 180,000. Okay, so 180,000 will be here, and investment in Wolfpack will be 380,000. Alright, so that's entry S. Next is going to be entry A. So we use entry A to adjust the subsidiaries account. Those have a different fair value from book value. So the two accounts we have, one is royalty agreement, and second one is goodwill, and the credit investment in Wolfpack. And the balance at the beginning of 2018 for royalty agreement would be its beginning balance of 100,000 and minus 1 year amortization minus 10,000. So, and then the remaining balance is going to be 90,000. So equals to 90,000. Goodwill still have a 60,000 balance. So total is going to be 150,000. Okay, so that's entry A. Next one is entry I. Entry I is to eliminate the intra-entity income that recognized by the parent company from the subsidiary company. So we debit income from Wolfpack and credit investment in Wolfpack. And the amount here, the investment income from Wolfpack is going to be 65,000. So question, how we get this number? So this equals to reported income 75,000 and minus the excess annual amortization. Because we are using equity method, so we need to make this adjustment related to the excess annual amortization, and then credit 65,000 from investment account. Next is entry D. Entry D is to eliminate this intra-entity dividend paid from the subsidiary company. So we debit investment in Wolfpack and credit dividend from Wolfpack. The dividend declared and paid by subsidiary is 35,000. The last entry is entry E. Entry E is to recognize the excess annual amortization. So we debit amortization expense and credit royalty agreement. $10,000 each year. Alright, so that's the journal entries. We need to consolidate entry. We need to prepare for the parent company at the end of 2018. Assume that Branson has applied the equity method. Question D. Prepare consolidation worksheet entries as of December 31st, 2018, assuming that Branson has applied the initial value method. If the parent company does not apply the equity method, then we always need to use entry C to convert the balance of the parent company retained earnings and investment account to equity method totals. And also this entry C should be recorded before other worksheet entries so that we can align the beginning balance for each year. Okay, so for this question, the entry C would be we debit investment in Wolfpack and credit returned earnings for the beginning balance of 2018 of Branson. Okay, so which means that here we are adjusting the parent company's beginning return earnings so that its balance will be the same as its equal equity method totals. And next, in order to get this adjustment amount, I can show what this difference comes from. Alright, so there are two methods. One conversion from initial value method to equity method. Right? So I have equity method. We have the initial value method. And the difference in parent company retained earnings is driven by the investment income. Or its income from the subsidiary company. If the parent company using initial value method, then the investment income equals to the dividend declared and paid by the subsidiary company. While if the parent company using equity method, then the investment income equals to the income from the subsidiary company and minus any excess amortization. So in this question, the dividend that declared and paid in 2017 is 25,000. While the dividend report and by the Wolfpack is 65,000, and the annual adjustment is 10,000. So this is the annual amortization. Okay, so if we come back here, the dividend declared and paid by the subsidiary company is 25,000, which means that when the parent company using initial value method, then investment income is 25,000. However, if the parent company using equity method, then the investment income should equal to 65,000 and minus the 10,000 excess annual amortization. So if we compare these two numbers, a difference of these two total should equal to 65,000 minus 10,000. So this is investment income in equity method minus 25,000. It gives us 30,000. So 30,000 is the amount that we need to convert the balance of retained earnings from initial value method to equity method. Or in other words, if the company using initial value method, then its retained earnings is going to be reported smaller than equity method totals by this amount. So that's why we credit retained earnings of the parent company. And the amount here is 30,000. 30,000. All right. So this is the entry star C. So C here means conversion. While convert the initial value equity method retained earnings to equity method retained earnings total. Alright, so after we prepared entry star C, then we can prepare other consolidation entries. The first one is entry S. So entry S is to eliminate the subsidiary company's equity account. And what we can do is we debit common stock. We debit retained earnings. So this is the subsidiary company retained earnings, and credit investment in Wolfpack. Okay, so total common stock balance is 200,000, and retained earnings is 180,000, and the way we get this 180,000 equals to the equity method example. 380,000. Okay, and the next entry is entry A. Entry A, we debit royalty agreement. Goodwill. And credit investment in Wolfpack. That is 35,000. Oh, sorry. Okay, royalty agreement is 90,000. Goodwill is 60,000. Investment is 150,000. So these two entries are the same as what we prepared for assume the parent company using equity method. So for example, royalty agreement 90,000 equals to the initial balance of 100,000 and minus 1 year amortization. So that equals to 90,000. And the next entry is entry I. So here, when the parent company using initial value method, then the income that recognized on the parent company book or investment income recognized book is the dividend paid by the subsidiary company. Okay, so then we debit dividend income. And credit dividend from. Wolfpack, 35,000. And we do not need to prepare entry D because dividends is already been taken care of by the entry I. And the last one is entry E. So E is for the excess annual amortization expense. We debit amortization expense and credit royalty agreement. $10,000 every year. Alright, so that's all the consolidation entries we need to prepare if Branson applied initial value method.